This one report can ruin your underwriting, dramatically increase your insurance costs, or cause buyers to walk altogether. And many investors never even check it. Welcome to Strategy Saturday. I'm Charles Carillo, and today we're breaking down loss runs, what they are, why they matter, and how smart investors use them to spot risk, negotiate price, and avoid insurance nightmares. So let's get started unpacking the entire report so you can spot potential problems early, negotiate more effectively, and avoid costly surprises down the road. So loss runs are detailed insurance reports that show the claims history of an insured party and outline each time that an insurance policy associated with a business or property has been used. Now, most loss run reports will list all claims, if any, over the past 3 to 5 years, and they're typically utilized for business insurance policies, which can include commercial properties. Since our show is focused on real estate investing, I will focus my explanation mainly on how loss runs pertain to real estate investors. Additionally, when I say commercial properties, most people think of large office buildings, but loss runs will be a factor for all size rental properties. Every time I've sold a rental property, the buyer has requested loss runs, even with small 3-unit like apartment houses. And a loss run report will typically contain specific information such as the insurer's business name, policy numbers, and the dates of coverage. If there are no claims, the report will simply say no losses reported. If there are claims, it's going to list the date of when the claims occurred, the date when the claims were reported to the insurance company, a brief description of the claim incident, fire, theft, water damage, the specific insurance policy involved, whether it's commercial property, a general liability, etc., and the total amount paid by the insurance company, settlements, legal, property damages, and the amount of reserves the insurance company has set aside for future costs if the claim is still open, and the status of the claim, whether it's open or closed, which is extremely important too if you're buying a property or looking at a property with an open claim. The why are loss runs important in real estate? Well, for buyers, most importantly, the loss runs will indicate how difficult and expensive it will be for the new owner to insure the property. Now, a property with a claims history of significant payouts will make it much harder and much more expensive to insure. And this most likely dramatically changes the insurance premium they are estimated in their underwriting. Okay, so maybe you're just using general underwriting, and then maybe once you get down really into underwriting before you put the offer out, you go and get a quote for what the property will actually cost. And that's going to be one thing they're going to ask about. I'm looking at 5-unit buildings, and this was insurance from 5-unit building on the street, and this is a 5-unit building. So underwriting over here, so I'll use the same number. I'll just plug it in over here and think it's going to be the same in my underwriting. Well, you put those loss runs in there, and now it changes dramatically everything that's happening at that property in the eyes of the insurer, and then the eyes of what your premium is actually going to be. Additionally, the loss runs help identify red flags and will allow buyers to understand the historical risks of the property. Not every problem is going to have an insurance claim, but if you see someone slipped on the property, well, I'm going to take a little bit more look around everything when I'm there and saying, where could people slip at this property? Is there an issue? What could be a problem when I buy it? If people are slipping here, maybe one person filed the claim, they sued. There might be another 9 people that also slipped, or 9 times that they didn't sue. So this is a super important thing that buyers need to look at. And for buyers who see claims due to water leaks and plan to repipe the property, this will alleviate these potential claim issues. But if the buyers did not account for the issues, it might be wise to perform further inspections. If there are several slip and falls on the property like we talked about, it's possible that the management has not been managing the property correctly during winter storms, which is one way of doing it. And if your management's better, then it's something that you'll probably decrease that or eliminate it. Additionally, it could also speak to the tenant profile and what the new owners can expect. So if you're getting a lot of slip and falls, or you're getting a lot of you don't see any issues per se, and the management was very good, this might just be the class of property and the tenant profile that's at that property, that's attracted to that property, that lives there. And you might expect then, okay, I'm going to have claims here, and this is something that I'm going to have to get used to if I want to buy this property. And then also my insurance is going to be higher than other properties possibly, in the area of the same vintage. Now, buyers can utilize the loss runs to uncover red flags, which can leverage them to lower the property's purchase price. So with all this due diligence you're doing that the loss runs are really uncovering for you, that you're kind of going in there and digging deeper, at the end of the day, if you go forward with the property, and maybe it could be a one-off thing, that's possible, right? So if you're looking at loss run and there was, one claim 4.5 years ago, something like this, okay, I got that, that's a one-time thing. If you're seeing multiple claims, especially if they're like similar, that might be there's an issue, and maybe it's because of old management, but you're going to have to make the decision of, was it bad management before? Which you can tell by the, even if there's no snow out there and people were slipping on ice, you can probably tell by how the property is being managed at that point. But if it's not, then it's something that might be inherently a problem with the property that is just going to lead you to paying more for insurance. Now, for insurers, loss runs, it helps them assess future risk. Insurers can, they review the severity and cost of previous claims to analyze future claims and potential for them and determine whether to offer coverage and set the price for that coverage. Additionally, I feel insurers are always gauging the quality of the property management when reviewing loss runs and pricing policies. If the claims are average for the area and the class of property, etc., but maybe they exceed the average, it might indicate that the property manager is subpar, and it might not just be the property itself. And this is something too, for owners, sellers, or property managers, the loss runs, it helps sellers prepare to sell a property. If they had a large claim 2 years ago, they probably want to wait at least another year before listing the property for sale, right? Because now they can give a clear 3 years of loss runs, nothing reported. For property managers, reviewing the loss run report might expose negative management trends that have been adversely affecting the property. Maybe it's time to re-roof the property, repair the driveway or the stairs. Management may need to be more proactive about snow and ice removal. And additionally, the drains that pour out into the sidewalks and cause slipperiness that people could be rerouted somewhere else around walking and driving areas. Loss runs are really a credit check for your property, and where buyers, lenders, and insurers can understand the potential future liabilities by reviewing the property's claim history over the past few years. And loss runs directly impact the cost of property insurance, making it a crucial factor when underwriting and purchasing a property, since a property with many claims will make it much more difficult and more expensive for the buyer to insure. I remember a property I had years back, it had a claim on it for, I think it was like $2,200 or something. I changed insurance companies and they're looking at it and they say they're going to give me a lower premium on the property. And they said, we'll give you a lower premium. However, your deductible can't be $1,000. It's got to be $2,500. And that was just covering one claim I had on loss run. So it's important that you understand loss runs and how it affects you as a buyer and a seller. So I hope you enjoyed. Please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. If you're interested in actively investing in real estate, please check out our courses and mentoring programs at syndicationsuperstars.com. That is syndicationsuperstars.com. Look forward to 2 more episodes next week. See you then. Have you always wanted to invest in real estate, but didn't have the time, didn't know where to find the deals, couldn't get the funding, and didn't want tenants calling you? Since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.